Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is December 20, 2023. I want to play one thing from this last video that I did yesterday, one piece that I don't know that it's relevant really for right now, but it was the piece that stood out to me the most. And that is, it was my first clip, is on gold. I'm not going to play the clip, I'm just going to make some comments on it. I do not buy gold currently. I have bought mostly silver, and I use silver, physical silver, as a method to insure against the decline and perhaps the eventual collapse of the dollar. When you look back historically, for thousands of years, or all the civilizations, all of their currency has always gone to paper, or if it was in coin form, they have used filler to devalue their currency, always. And always their currency has collapsed because there's really nothing behind it. And in the most recent period, the last 100, 200 years, you'd say, okay, with the US and the UK and a lot of other countries, okay, we've got paper currency, and it hasn't collapsed, but they have declined dramatically and are now worth pennies, sometimes barely pennies on the dollar for what they originally were. So there's still been the printing of money, the devaluation of currency, and the only thing that has held its value that has actually gone up during this period that I know of is gold and silver. So when you look back over thousands of years, you could say gold and silver have held their value and they have intrinsic value. And so for that reason, I use it. I use it as an insurance policy. So underline that, insurance policy. It's not an investment. I don't even think of it as currency. I think of it as an insurance policy, and one day I may need my insurance policy, but I hope I don't. And if you look at it like that, then you don't get caught up in these arguments of it's a bad investment. Actually, from an investment standpoint, it's actually been, depending on the period of time you capture, has actually been a pretty good investment. But I don't look at it like that. I think that's dangerous because it will go up and down, but when the dollar and other currencies collapse, if we have a reset and there is a collapse, in my opinion, I think there will be. I don't want it, I don't wish for it, but if that happens, you will be glad, in my opinion, to have something of intrinsic value. Okay, now I'm going to jump into the dashboards. This is last week. Last week was an excellent week in the stock market. What happened was, part of the week was that the Federal Reserve had their meeting, and the market, and Chairman Powell said, we're pretty much done with raising rates, and gave an indication that the next thing on their calendar at some point is going to be reducing rates. Well, the market just took off. So we've seen just some very good response to that. So the yellow box indicates the gains that have occurred in all of these indexes, including the last one, which is the long-term government bond. It's been beat up a lot and it's down still huge amount, but it needed a boost, and it got a boost last week. So you see from the 4 U.S. equity indexes, the Dow, the S&P, the NASDAQ 100, and the Russell 2000 small cap index, all 4 of them did very well. The 2 foreign indexes did well, the emerging markets and developed markets. So everything in the yellow box is green. That's great. So I think we're all glad for that. When you look at the year to date, you look at the NASDAQ 100, up 52% for the year. Then you go into the S&P 500, up 22%, and it goes on down, and the long-term government bond is slightly negative for the year still. Then this is interesting. We haven't seen this for a while. I have seen it before. Look at those green dots. That shows that for the 20, 50, 100, and 200-day moving averages, all 6 indexes, including bonds, are all above all of those moving averages. So that's a very positive sign, and I'm glad to report that. Then when you break the S&P apart to its component parts, those are sectors, segments of the economy, and there are 11 of those segments. And we look at each one of them. Sometimes they are very different from each other, but they comprise, when you put them together, they comprise the S&P 500. So again, very unusual, but I'm glad to report that in the yellow box, everything is green and has done very well. The one that has done the best was real estate and retail. Those were the 2 that were the highest performers. When you look at year-to-date, very positive, especially when you look at the technology and the consumer discretionary of 54 and 38%, and then it drops down, 17, 15, 9, 9, 8, and then the last 4 are negative still on a year-to-date basis. The most negative is consumer staples. Consumer staples down 4% for the year-to-date, and energy down 3% year-to-date. So yes, you've got these real high flyers that are doing well, but you have some that aren't even at 0. They're below 0. So, but all of it goes to make up the S&P 500 on a weighted basis. Okay, so when I put this on a chart, take the S&P 500, put it on a weekly chart, 1 move equals 1 week, and I drew a line from October of last year, so this gets us, 13, 14 months. You can see the trajectory of the market. Yes, there's been ups and downs, but by and large, it's rising and rising. That last bar, the move on the line, you see the dramatic move up at the end, and that's basically came from this last week. The other way to look at the S&P is the types of stocks inside of the S&P. So you have growth stocks. We looked at 11 sectors. Of those sectors, there were growth sectors and there were value sectors, both in there. When you look, when I put those on a relative strength chart, I put growth as the numerator and value as denominator, then you get a relative strength chart. And there are ETFs, exchange traded funds, which we use for that purpose. SPY-G is for growth, SPY-V is for value. And when this goes up, it favors growth because it's the numerator. When it goes down, it favors value. So if you look at since the beginning of October, so this would go back 2.5 months. So 2.5 months, I put a black line. Look at the trajectory. It's down. What does that mean? It means that value stocks generally are more in favor than growth stocks. Value stocks are more in favor. But since the beginning of this year, up to that point, up till, say, the 1st of October, by and large, growth stocks were in value, in favor. Now we do another relative strength chart showing large cap, large companies, compared to small companies. Large companies, meaning the S&P 500, the 500 largest companies on the stock exchange, compared to the Russell 2000, the 2,000 smallest companies on the stock exchange. Large compared to small. So when it goes up, that favors large companies are growing faster or losing less money, as the case may be, than small companies. When it goes down, that favors small companies. Small companies are actually doing better when it declines than larger companies. So take a look. I put a black arrow at the end, and you can see, this takes us back to the beginning of November. You can see from the beginning of November to present, small cap has way outperformed large cap. They have both been going up, but small cap has been going up faster. Long-term government bond. This is not a relative strength chart. This is an absolute chart. So when you see the 20-year government long-term bond exchange traded fund, TLT, you can see that the trajectory from about mid-October until present, look at the upward trajectory. Bonds are moving up quickly. They moved through the 20-period moving average and are moving up. They went from, about 83, something like that, up to around 99. That's a pretty sharp move. So good for bonds and good for those who hold bonds or even conventional 60-40 portfolios. It's a representation of the bond market, even though there are different kinds of bonds. This is the dollar represented by the ETF UUP. It's a 30-month chart, and generally the dollar has been declining for the last couple of months. Gold had a sharp week down last week, but then had a recovery, and this week a slight recovery, and went back up a little bit. And you can see since last November, so this would be about 13, 14 months, that the general direction of gold is up. Silver, same thing, had a sharp decline last week. You can see that on the far right of the chart, and then you can see the sharp increase in value at the very end, and that was this week. Up more than gold, but not enough to recover what it lost the previous week. When I put the two on a relative strength chart, putting silver as the numerator, gold as the denominator, you can see that it basically goes up and down a lot. But, since silver outperformed gold this week, you can see that rise at the very end. But when it goes down, that is favoring gold. Bitcoin has been doing very well since November of last year, so this would take us back about 13 and a half months. And you can see the trajectory is up, and it was down this last week, but that's that tick down at the very end. But by and large, Bitcoin has been doing very well. Volatility. Now, volatility is kind of a negative measure. So when the market is going down, volatility index, called the VIX, is going up, and vice versa. So when the market's going up, then volatility is reduced, and the volatility index tends to decline. So I gave you two arrows here, one showing the longer-term trajectory with the black arrow, and the shorter-term trajectory with the red arrow, even a sharper decline, which tells you that the market is not experiencing downward volatility. Asbury Research last week had the same indicator. They had the rate of change on the S&P 500 was negative, and all the other indicators were positive. And 5 out of 6 is a positive indication from Asbury 6. The cross-asset relative performance matrix compares one asset class or one type of stock to another. And I'll look at the ones that just were positive for the last week, the last month, and the last quarter. Those are the three columns to the far right. High beta stocks were better than low beta or low volatility stocks. Small cap, as we saw in that previous chart, small cap clearly did better than large cap. Blue chips, meaning the Dow Industrials, did better than the broad market, the S&P 500. Technology did better than the broad market. And the U.S. did better than developed markets. Corporate bonds on the bottom section, corporate bonds did better than government bonds. And corporate bonds did better than high yield bonds, and long-term bonds did better than short-term bonds. U.S. versus the world. The ones that outperformed the U.S. are in green, and for all 3 time periods, Chile, Peru, Mexico, France, India, and Australia all did better than the U.S. when measured over the last week, month, and quarter. And when I say they did better, what I'm using is the ETF, which is in the second column, which is compared to our ETF, which we use as a surrogate indicator called SPY. The U.S. did better in the following cases, in all 3 instances. The United Kingdom, Japan, Hong Kong, Singapore, China, and the Pacific. I thought what I would do, I've done this before, I thought I would do it to show you 2 charts to just give you a relative strength, comparing the U.S. to 2 markets, one where the U.S. did better and one where the U.S. did worse, to show you what that looks like. So this is one where the U.S. did better, and the chart I thought was the most compelling was the United Kingdom. We did better than the United Kingdom since May. Just it's comparative. So the market could be going down and we would just go down less. Market could be going up and we would go up more. So it's relative. So relatively to the UK, look how much better we did since the month of May, measured by the black arrow. When I turn it around and look at the other side, who did better than us? The one that did better than us the most was the country of Mexico. And so again, I'm just showing the last couple of months, but you can see from going all the way back to August of 2022 to present, the long-term trajectory is Mexico has been doing better than us. Their market has. And then their currency is not, but their market is. And then more recently, in the last couple of months, they have been expanding that trajectory to do even better than the U.S. So it's important that when you look at things like this, that you make sure you understand what relative strength is. The other thing is don't confuse the currency with the market, or for that matter, even the economy and the market. Okay, we get to gold and silver. Gold, as I told you earlier, had a positive week, and it was up, in this case, 0.8% over the previous week. This is measured from Friday to Friday. It's 2023 is the spot price. Silver, excuse me, the spot price is 23.93, up 3.5% from the previous week, and that makes the gold-silver ratio on the spot price 86-1, favoring silver is a better value. Silver bullion, just generic silver, is you can buy it in by the ounce, you can buy it by the tube, which is usually 20 ounces, or you can buy it by the monster box, which is 500 ounces. A monster box, 500 ounces, is $13,090 as of last Friday. This is $26.18 per round, and that includes $2.25 markup over spot. When you break it down to a tube of 20, it goes up 50 cents. So it would be $26.68 for a tube, including the $2.25. Actually, in this case, it would raise the markup from $2.25 to $2.75. And my son Preston is the source of this information. These are the prices he sells it for. So if you want to shop this locally with your local retailer, this gives you a benchmark to look at. Okay, well, thank you for watching. And if you have questions or comments, leave them in the comment section below.